All right, we are live. Phil, you might want to mute your mic when you're not talking. Feels like there's background noise, like a fan or something.
Okay.
Maybe it's not, but okay, perfect. Yeah. Um, all right, I think we're live. We're on the socials. All right, let's get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I will be your host, and today I'm joined with my good friend Phil Weiss. Hey, Phil.
Hey, Kirk, how are you today? Happy Friday.
Happy Friday. Happy Friday. Just got back from my backyard ice rink. I was playing around back there. It's 40 degrees out, so I was I was skating around in slush, but that's okay. That's okay. It's raining today. I guess we're bound to have some weather that's not perfect for the ice rink a few times this year. Otherwise, it's been perfect all year, and it's going to rain all day. So I'm not thrilled about that. But anyway, enough about my backyard ice rink, or I call it my winter pool. This year it is not a pool, so I'm happy. Let's kind of dive into the week. This has been an interesting week. We've had nothing but news all week. The corporate media must love this week because every day Trump's coming out with a new presidential executive order. You've got confirmations where I was listening to a podcast earlier, was talking about this, and I was actually interested because I don't watch any of these things. I think it's all theater anyway, and I have no interest in wasting my time with theater, political theater. But one of the guys dissecting this, and he's like, it's really interesting because basically it's just grandstanding. Like the senators sit up there and they yell and scream and curse at them, and sometimes they don't even give them a chance to talk. They're just yelling and screaming. They're like, "All right, next." And it's like, what was that? It has nothing to do with anything other than them being self-important. So this is why I don't follow politics and why I don't care about it, because it's all theater, and it's really just for them so they can sit there and send videos to their supporters and how they yelled and screamed at one of the people who came in and how they don't agree. And what I found funny was I saw a chart, and when Kennedy was being grilled, and I didn't see this, I just saw clips, but I saw the people who were supposedly grilling him, and who were some of the top people grilling him. Well, it was the top recipients of pharma support. Elizabeth Warren. You had Bernie Sanders number one, Elizabeth Warren number two, and I think Amy Klobuchar or whatever. I don't know. There were a bunch of people who were on the list. They were the biggest recipients of pharma money, and they were the ones grilling him. You're grilling him about why they shouldn't be forcing everybody to vaccinate. No, there's no bias there whatsoever. It doesn't matter whether you agree with it. It's just the point. It's just the whole thing's laughable, and that's our political system is set up, so it's made to make them look self-important, but it doesn't do anything for us as citizens. Anyway, so that was my comedy for a week. I saw that and I just started laughing, and I saw one thing with one clip with Kash Patel where I forget who was yelling at him, but it was anyway, one of the senators was yelling at him, and they're like, well, if I had all day I'd do this, and he's like, you have 2 minutes, Senator. I thought it was the funniest comeback. He's like, you have 2 minutes, Senator. So I have to say, I give that guy a lot of credit. It must be very intimidating sitting in front of the group of people who are just yelling and screaming at you, and you just have to sit there and take it. So kudos to him for firing back. Anyway, so it made for good videos, but otherwise it was useless. So I don't recommend anyone watching that. But anyway, so yeah, so wanted to talk about a bunch of stuff because I think the last few weeks we've been talking about the Trump effect and what the impact should be for inflation. I've seen a bunch of things in the last few weeks, and I wanted to talk about one of them. And Stanley Druckenmiller talks about the 3 death nails for markets. And I want to bring this up. I know we're a little bit delayed because this actually changed around mid-January. So before Trump got in, it changed. But I want to talk about it because I think as a theme, as a framework, it's good to understand. So what he talked about is the 3 death nails for the markets. And it is simultaneously rising interest rates, dollar, and oil prices. And I want to talk about these because prior to Trump getting in, this is what was happening. Interest rates were going up, the dollar was going up, oil prices were going up. Now, subsequently, oil prices have dropped. U.S. dollar has dropped, or it's not continuing to go up. It's dropped a little bit. I wouldn't say it was a huge drop. And then you have interest rates, which, frankly, they've also changed track. So since Trump's in, this has actually changed. But I want to go over the framework. So here's why it's important. We had rising interest rates. So we had Powell, who dropped interest rates, short-term Fed funds rates, a whole percent or 100 basis points within a short period of time. Within that time, long-term interest rates went up 100 basis points. It's almost, I don't know that that's ever happened. So it's really weird. Basically, what that says, the bond market's right and the Fed is wrong. So whatever the Fed was doing, the bond market disagreed and said no, interest rates should be higher. On the longer side, just to be clear, because the Fed controls the short side and the bond market controls the long side. No one controls the long side. The Fed tries to, but they really truly have no control over that. That is the stock market, and they have no control. So basically, if you have rising interest rates, here's what happens. It makes it more expensive for companies to borrow money. So there's certain businesses that typically get impacted by raising interest rates. And these are businesses that require a lot of debt, right? You take like a mining company that takes out a huge amount of debt to go build a mine, right? Or they're selling equity. That's a little different. But you've got businesses that typically run on debt. Then you have some businesses which are very light on debt. But what's interesting is like technology, which doesn't typically rely on much debt. It's usually a lot of equity that's sent out to people. The big tech companies started to borrow because they realized they can borrow for zero and then buy back stock, and that increased their stock prices. So you want to know why a tech company that's not growing continues to grow in their stock price? That's why. Apple did this, I think, about 8 years ago, and it's caused their stock price to continue to go higher, even though their business is not necessarily growing at a commensurate rate. So rising interest rates does impact corporate profits, right? For companies that have floating rate bonds, it just means that higher interest rates means that they're going to have to pay more. Companies relying upon real estate, so interest rates impact everything. You should think of it this way as a frame. Higher interest rates equal lower profits or declining stock prices. Now that is held true for a long time, except for somewhat recently when it's been kind of disconnected. Or in 2022, I think it was, when the stock market and the bond market all crashed at the same time. That was a not unique, but that was a kind of rare scenario which happened in the 70s, but it hasn't happened a lot. Most times they're inverted. The second one is a strong dollar. So here's the problem. A rising dollar also puts a challenge to corporations, especially multinational corporations. So multinational corporations, it means this dollar is stronger. So if you as a traveler, if you're traveling the world and you're going to like Europe, right, and that we have a strong dollar, it means your dollar can be exchanged for more euros, which means that it's things are cheaper for you to buy in Europe. So I remember in '99, I went over to Italy. I was in college and we had a class over there in the summer, and we all went over there and it was a lot of fun. It was in the middle of the World Cup. It was a lot of fun stuff. Anyway, it was dirt cheap. The dollar was super strong, and the currency over in Italy, I think it was the lira back then. They had not converted over the euro yet, or not completely. So not only were things cheap there anyway, but they were double cheap because I could buy twice as much stuff. So whatever I wanted, I could buy twice as much of it over in Italy, and on top of the fact that they were cheap anyway in comparison to other European countries. So I mean, literally, people would come over. Japanese tour buses would come over. They'd go to the outlets for some of these really high-end brands, these Italian brands, and they would just clean it all up. They would take it all the stuff, put it in bags, and they would buy it and leave. Because at the time, everything was really cheap. So they saw that and went over there and did their stuff. I thought it was fascinating. It was a good first lesson in global economics. But so the challenge is the conversion, right? And another challenge is in emerging markets, because emerging markets usually have debt to the U.S. government or agencies. I call it the government, even though they're NGOs. Um, and they borrowed money from our NGOs, and that's based in dollars. So what happens is if the U.S. dollar gets too strong, these countries can't pay it back in dollars because it's much more expensive. And so the strong dollar around the world becomes problematic for many reasons. Many reasons why we try to keep it somewhat weak. Other countries try to do the same. Everyone can't keep a weak currency, but that's kind of a competition that goes on globally. And the last one is rising oil prices. So rising oil prices, the problem with this is the transportation sector and the manufacturing sector highly rely on oil prices. So if you have high oil prices, all of a sudden the goods that you're buying, they're getting transported from somewhere else. Well, that takes oil. And if oil prices are more expensive, it means your goods are more expensive. It also means companies that are selling those goods or transporting them, now they have to charge more, or they're losing money or profits. So it creates a bit of a problem. And this up until the 15th or right around there was, I guess, what he would call a perfect storm for stock markets. And so if you have this continue to happen, it's all these negative influences start to take down stock prices, or should. And so I'm not seeing it at the moment, but I thought it was a good frame to keep in mind, because if it comes back, they've all kind of taken a pause. They've come down a little bit, but they haven't come down a lot. So it could be a pause and they could keep going higher. And if that's the case, you want to be really mindful of how this is going to impact your portfolio and earnings, because it's definitely going to impact earnings, maybe not necessarily immediately, but over time it will. So I don't know, Phil, I mean, you have a strong background in this. What are some of your thoughts?
Your point is, the point about oil prices really matters, and it's not just transportation. You also have to remember that oil and oil derivatives are used to make plastics. They're used to make a lot of chemicals, and so all those costs can go up as well. So there's the manufacturing costs that can happen, and the other thing that all happens when you're talking about here, if you're a multinational company, I know you said if you're a U.S. consumer and you go over to Europe, you can buy things cheaper. But if you're a U.S. company that's selling your goods into the foreign country, then it becomes more expensive as the dollar goes up. So that for them, it's harder. Like it's harder to sell those goods there because they have to pay more for it because of the fact that they're paying in their currency and they're not buying as many dollars with their currency. I know I worked for multinational companies, and this was always a big issue. At the time that I did, it was before the euro, and so we actually, one of the companies I worked for, we had regular meetings, and we would talk about hedging because we would try to balance off those different things. Like the first thing that we did is we look at what were our net amount going in and out of that country so that we could offset things. But it was really important to hedge because, you know, when companies release earnings, they talk about the effect of dollar. Multinational companies always talk about the effect of dollars on their earnings, and they'll try and give you like their inflation adjust, not inflation adjust, but their currency adjusted earnings, so that they kind of try and take some of those effects out to try to normalize things. So these are really important factors, and if they're all going against this, I can certainly understand what Druckenmiller is talking about in terms of its effect on the market, because all those things had negative impact on companies' profits and their activity, and that's normally you would expect that to be a negative for the market.
Yeah, and we're just sharing a chart now, which kind of shows that 41% of revenue from S&P 500 companies come from abroad. So many companies are multinational now, like they're global companies. Small caps tend to be less global. So for those of you who want to diversify, there's something to think about. Is larger companies tend to be global, smaller companies tend to be more domestic. So the strong dollar doesn't impact the local, the smaller companies quite so much because we're all operating in the same currency. You know, so if I start a company and my whole business is in the U.S. and I don't need anything internationally, it doesn't matter because we're using the same underlying constant, which is the dollar. It's when you have exchange rates with other currencies that the exchange rate is up or down, that does impact profits, and they do have to hedge themselves. But to see 41% of the revenue coming from abroad is actually quite interesting. And the chart here just shows the fluctuation based between like 35% and like 43% over time. and it ebbs and flows, right? There are times where it goes up and it goes down. But it's interesting to see, and I think it's a good overlay, because if you're really thinking about um, how it's going to impact your favorite company, it's just something you need to consider. I'll also mention that nowadays it's almost irrelevant for any of this stuff, because the fundamentals don't really matter. It's not that they don't matter; it's just the market doesn't care about it. And I think there's a big difference between that, right? Yes, it matters. It matters to profits, matters to all that. But when the market disregards it, that is, in a sense, a signal to you that the fundamentals don't matter. So if you're one of these fundamental analysts and you're getting caught up in the weeds, just know that your analysis is going to be useless at the moment. It's not irrelevant. You need to do it, but you need to consider that what the market um, the only truth in the market is price. Doesn't matter what you think and feel. Doesn't matter how quote unquote right you think you are. The market is the final arbiter. They are the judge, jury, and executioner. So if you're looking at a price and you're like, this is ridiculous, doesn't matter if it's ridiculous. The market thinks that this is the price. Now, and this is getting into second level thinking, right? Most people think, oh, I found something cool and the market didn't realize it. I'm going to be rich. And what you don't realize is your opinion doesn't matter. The market doesn't care about your opinion. It may never see your opinion, or it might be 20 years later. What's the old phrase? The market can remain uh, uh, irrational longer than you can remain solvent, right? And this is the thing: you could be right, but you could be wrong for 20 years until you're finally justified. You know what you call that, Phil? Wrong. You call it wrong,
Absolutely.
right?
Absolutely.
Even if you're right, you could be totally right, but if the market doesn't realize it, you're wrong. And I have to point this out because it's hard for us as investors to see that, because we're egocentric. We think we're all smart. We think that our method is the best method, or we wouldn't use it, right? It's just natural. Um, so we think that what we come up with is correct. The best investors or traders know that no matter how much analysis they do, if the market's going against them, it means they're wrong. And they have to acknowledge that, and they have to pivot and move on. I'm wrong. Whatever my thesis was didn't work out. Move on to the next thing. Let's find something that does. So for all these people, like Jim Chanos, who's one of the best short sellers of our era, who even tell you that you shouldn't be short selling. It's a fool's errand. It's hard to do. And the problem with short selling is you can be wrong for a long time. And that means you're going to lose a ton of money. And so it doesn't make sense to short in a bull market. That's you don't go long in a bear market and you don't go short in a bull market. Those are the kind of the basic rules. So, I know a lot of people feel like they should be hedging or going short. And I hear this all the time. Can I short the market? Yeah, you can. I won't work with you if you're doing that, because you're going to lose a lot of money and you're going to blame me. No, we're not going to go short the market, even if it's a good idea, because the odds are stacked against you succeeding by shorting the market. Now you can hedge. We do a lot of hedging, and hedging is basically defining the risk. So instead of having you buy a stock for $100, it could go up to 1,000 or it could go to zero. Well, that's defined on the downside to losing all your money, or zero, or the upside is unlimited. Well, that's not a defined parameter, and the probability of it going to unlimited is close to zero, right? The higher you get, the less likely it is to happen. But the most you're going to lose is 100% of your money. Well, what is the probability of the stock going down 10% or up 10%? Well, the probability might be 70% that it happens. Okay, well, what if we just defined the parameters to plus 10 and minus 10, and you had a 70% chance it was going to fall within those parameters? Okay, well, now you've defined your risk. You can say, I like this or I don't like this, right? That is hedging. That's one form of hedging, right? There's many forms of hedging. One of the ones that people like Jim Chanos probably do a lot of are they might go long Microsoft, short Apple, right? Which is what we call a delta neutral hedge, which is basically if the stock market crashes and everything goes down, one's going to offset the other. so you're not going to lose out. But the challenge with that is you're basically betting on one company being better than the other in their stock price, and that's all you're basically doing. So the risk of a crash is mitigated because they would both go down together. Hypothetically, of course, it might not happen, but there's lots of different hedging strategies out there people use to manage risk, and we try to go over some of them here on the show. Ultimately, if you don't know what you're doing, call somebody like myself or someone else who's familiar with this, because most people are not familiar with hedging. They're not familiar with risk management because everyone just goes long 100% all the time, and their definition of risk management is we'll buy some bonds, which didn't work out for you in 22 because it just didn't. So, all right, I did have a chart here, and since Phil's our oil expert, I wanted to share it. These are the largest oil reserves by country. I love this chart. I thought we were higher. We're actually 6, 8, 10, 11. We're 11th place. So I don't know if you've seen this, Phil, but like, Venezuela being, the biggest, which I didn't realize they were the biggest. I thought Saudi Arabia was. So when you see this, what kind of comes to mind in how this impacts people in their investing?
Well, the first thing I think about is also there's the quality of the oil that they have.
Mm-hmm.
And Venezuela has a lot of heavy crude. And so it's much more expensive to produce. And we have, especially if you think about the shale oil that's really boosted the production in the US, that's very light. It's easier to process. It's more profitable. So it also sells for more. So it's not just the size of the reserves that matter. It's also the quality, because there's so many different grades of crude. It's like in Canada, they have tar sands. And so tar sands, like that is really tar that they make into oil. And so they have to pump it with oxygen and pump it with water and heat it up and basically boil it so that it gets soft enough so they can get it out. But they mine it, as opposed to when we extract it, through a drilling process. So it's different, so that not oil reserves are created equal. It's been a while since I've seen this, so I didn't realize, I think that, or had forgotten that Venezuela had as much reserves as they had, but I know that it's a real issue there because of the quality of the oil, and they're not friendly to other companies that come in, so that their production is really, really low because they don't have the money to produce. And like companies that had activity in Venezuela, they don't really do business there anymore. Venezuela cedes their rigs and things like that. So there's just not really a lot of activity. So that's oil that doesn't really contribute very much to what's going on in terms of current production. But you always have to take into account what the quality of the oil is and not just the size of the reserve.
Yeah, and I think, so there's a few things I want to mention. So I appreciate you mentioned the quality of the reserve. That's really important here. I'm curious on your thoughts for each country and which has higher, low quality, but I did want to touch on one thing. One of the biggest challenges with Venezuela, and the reason that they get any interest from the U.S. at all, because if you look at all the South American countries, there's a lot of tin pot dictators down there that we just kind of leave alone because they're irrelevant to us. But seeing the size of the reserves of oil in Venezuela, now you know why we give any care at all to Venezuela and the dictators down there that are ruining people's lives. Now, of course, it's important to, if you care about people, but there's a lot of bad stuff going on in the world. Pick your country, right? We've got enough in this country to worry about. We don't need to worry about others. But the huge reserves they have is something to keep note. Another one, Saudi Arabia. Saudi Arabia, I assume, has a better quality of oil. Canada, you mentioned tar sands, huge reserves. What are the rest of the countries? We got Iraq, we got Iran, we got the UAE, we got Kuwait, we got Russia, Libya. Like, do they also have good quality of oil, Phil, or what?
I generally think of most of the countries in the Middle East as having relatively what's called light crude. Russia, it's a mixture. Russia has a lot of stuff that's offshore, and the water is very treacherous, so it's not so easy to get to. They do have some high quality oil as well, but you also have to look at offshore. And so like when we go to the Middle East, there's not a lot of offshore reserves. I believe it's Nigeria had some. So there is some that's offshore because, like, again, it gets to the cost of extraction. Like if you think about in the US, even if we go into the Gulf, and there's oil reserves in the Gulf, and so that's deep sea. And so there's a lot more that has to go into building those things, and it takes a lot longer to get the oil too. Like that shale oil that I mentioned before that we have so much of in the U.S., it's relatively easy to extract. It doesn't take that long, but like if in some of these places, especially when you have offshore, it takes years from when they discover that oil's there to when they can possibly get it. And there's a lot of things that they have to go through to get it out. But like if I think from a quality perspective, probably on this list, the ones with the lowest quality would probably be Russia, Canada, and then Venezuela would be the three that stand out to me as where they have a lot of heavy oil or just difficult to get oil.
Yeah, I mean, I'm curious also because you mentioned Nigeria. I remember seeing a chart. I thought Nigeria was like fourth or sixth in the world of where we I'm sorry, it was second or fourth for the oil that we take in, that we import into this country. I think it was like sixth in the world for, maybe it's production. Maybe I wasn't thinking reserves, but I thought Nigeria was high in the list, but apparently it's not.
I would have thought it was. I kind of thought it was hard too, but you know, a lot of it also depends in a lot of these countries how friendly they, in terms of how much we can get. It depends on how friendly the governments are in terms of taking outside assistance, because some of these countries don't have the technology to extract the oil either, because it's not so simple. And there's actually a lot of techniques beyond like what you can conventionally get, where they flood it with oxygen and other things to try and increase the production. You know, in Europe, you notice there's no European countries on there. That's why, like when we have the situation that we have between Russia and the Ukraine, Europe really gets hurt by that, because other than the North Sea, there's not a lot of oil or natural gas that's available natively in Europe. And so that they really rely on others to produce for the oil that they use. And so that's also why their prices are so much higher, because they're importing everything. So you have to think about that as well.
Yeah, it's a good point. It's a good point. We haven't talked about that much. I do want to pivot into another area, two more areas. One is housing, and one is actually, you might appreciate this, Phil. There's, I can't get this to, see if I can get this to do what I want. Come on. There we go. All right. Tech issues. All right. So there's a concept we call survivorship bias. And survivorship bias is something that most people don't think about, but you think about it in statistics. So when you see numbers, right? If you can look back, and this is this is not a chart crime. We're giving you evidence of how chart crimes happen. So if you look back hundreds of years, you'd say, wow, 100 years ago this happened, and 50 years ago this happened, and you look back long enough times, and it's all well and good, but there's a concept called survivorship bias. And survivorship bias is this, is that the metrics change over time because companies change. I mean, how many original Dow 20 stocks exist that are on the Dow? I think 0. I think GE was the last one, I believe. And so, things change, right? GE's changed as a company, and other companies have come and gone, and they will continue to come and go. But I think when we look at statistics, when you look at charts, right, and time frames, things change over time. So what we look at is the result frequently. Oh, look, the index, I remember there's one chart I used to see for a long time. It's like, wow, the holding period for stocks went from like, a year down to like 7 seconds. And like, wow, this is terrible. Yeah, but you didn't look at the data behind it. You just saw the result. And what you didn't see is that also includes high frequency trading. It includes a lot of stuff that didn't exist, 40 years ago. So, somebody's tipping the scale. Somebody's putting their finger on the scale, and you don't see the why. So you don't know if the statistics or the data result is actually accurate. It could be, well, without high frequency trading, that it's the same. So look at, and I don't have the exact stuff, but I'll talk through this example because everyone uses it. The infant death rate, or sorry, the average lifespan. So the average lifespan in this country, people say, hey, it keeps going up. Well, if you actually look at the data, and somebody told me this, so I don't know this 100%. So, but I just take this as an example. The reason that the average lifespan is going up is because the infant death rate is going down. And if you look back, we had a relatively high infant death rate. It was like 30%, 20 or 30% in this country, like way back, like back before like hospitals and medicine, stuff like that. Like it was really high and it's gotten really low now. But as that's happened, that's caused the lifespan to go up, because if you're averaging out people who are, 0 and people who are 100, you've got a lot of people in 0 and you've got very few people in 100, right? So if you look at the stats, well, it's effectively, you're saying, wow, we've got a lot more people that are living longer. Well, that's going to boost the average, right? The average. So my point is in all these statistics, you always have to keep in mind that if you don't know how the numbers work or flow through, you could get convinced of something that's not true. So I just wanted to share this because I thought this was interesting. This is the average company lifespan on the S&P 500 from 1965 to, I don't know why they put 2030, because we're not there yet, but I expect that's probably a guess. Anyway, so the point being is this is a 7-year rolling average, and it just shows in certain time periods, the lifespan goes down and goes up. Well, it's gotten really low since the 2000s, right? And you say, well, why did that happen? Well, I can guess, because of tech companies. Well, are tech companies all going bankrupt? No, not all of them. Many of them are merging, right? So the question is, what's included in this? Are mergers included in this? Because the truth is, and these have by decade the average like 29, 25, 25, 17, 21, 18. It just kind of shows. But here's the thing. If you look at companies, right, that are public, many of them are merging. You go through times, I think it was the late 80s, early 90s, when there was a merger boom going on. And you had the was it Barbarians at the Gate? We had the Nabisco merger. And so if you look at that era, right, there's a bunch of mergers or buyouts. And you look at other eras where there's spinoffs, right? And so we go through this cycle of acquisitions, and you go through another cycle of spinoffs. Acquisitions are, we're going to buy everything that's not nailed down. We're going to just buy it because it's going to make our earnings go up. And then they realize, well, we're losing a lot of money, and we're a crappy company now because we own 20 companies that are irrelevant to each other. and that's just dumb. So they do spinoffs, right? And so every once in a while you see spinoffs, you see mergers, and they tend to go in waves. Now, we haven't seen a spinoff wave in a long time, but if you see some good spinoffs, there can be some really good profits built in. Anyway, so we've seen the number of companies existing going down. So you're seeing here in the trend, the lifespan's going down, but also the number of companies have declined. So if you're looking at the average, well, the remaining companies are the average. The ones that aren't around anymore aren't. So you have to look at multiple different reasons why things are changing. It's not just clearly because the lifespan is going down. It's also because the number of companies in the data set is declining. And it could be the infant death ratio is tipping the scale one way for a different reason other than what you think. So I'm not saying it's a chart crime because I've never dived into the details, but on the surface, these are things I'd look at. I'd say, okay, yeah, it looks like it's going down, but also I know that the number of companies are going down. There's probably other things that I don't know, M&A, spinoffs, whether they're included, a lot of stuff. Maybe there are companies that are getting shuttered from the S&P, right? Because some companies move up into the S&P, right? Like some companies get boosted into the S&P when they weren't before, and then some companies get kicked out, right? And how is that impacted in this? Because if a company gets kicked out, maybe they're going to die quicker, and so maybe these numbers are too high, right? So there's a whole bunch of reasons that these things happen. So my point to you is, when you're looking at charts like this, understand what they actually mean. Any thoughts on this, Phil, before we get into housing?
The other thing that I just add, it's the same thing when you look at investment returns. Like if you look at mutual funds or ETFs, the longer you go out, the shorter the data set gets, because the ones that don't perform, eventually they don't take in new money and they can go away, so that those results also can be distorted. You have the same type of effect. But I do think, without knowing all the details, that you're right. Companies get kicked out of the S&P, companies get added. And so if they're only focusing on how long the company's in the S&P, that has an impact. In the S&P, I think there's more activity in the S&P now than there was years ago. And you do have the effect of mergers and spinoffs. Every time there's a merger, that company goes away. And by the way, you mentioned RJR. The RJR Nabisco, I worked on that when I was a tax guy.
Really?
Yes, I did.
Tell me about that. I'm fascinated. I love the movie, the book, great book. So tell me about that.
I arrived in Atlanta the day Barbarians at the Gate ended. So I was working for Deloitte at the time, and that was the two main companies were Forsman Little and KKR were the two that were really battling for those companies. And the partner that I worked for at Deloitte at the time, he worked on the Forsman Little team. And when KKR won, Teddy Forsman was so upset that he told Deloitte that if anybody that worked for him on that deal went on after the deal happened, that he would fire Deloitte. So the partner that I worked for, I hadn't worked on at all. He sent me to Atlanta without him. And I was 2 years into my career at Deloitte, and I had to work with a bunch of people that I didn't know. But it was a crazy place to be. I mean, just to talk about waste and things like that. The cubicles they had in their headquarters in Atlanta, they were mahogany. And they were huge. And so when they moved out of the building, they couldn't even sublet because these cubes were too big and they couldn't get comparable materials. They used to have carts that came through a couple times a day. You know, we worked really long days. I mean, I had weeks where I'd put in 70, 80 hours of time, work time, because that's how hard we had to work. But they would bring out these carts with all kinds of Nabisco products, all the different, and it wasn't just Nabisco, but it was, Lifesavers and Planters and all these different brands that they own. Before I got there, the guys told me that even they brought out the carts and they had cigarettes on them too. But it was crazy. And I spent 6 weeks there working. I saw like where Ross Johnson was the head of Nabisco. His office was ridiculous. They were in this really nice building outside in the in the suburbs of Atlanta. And then I went back over the summer and spent another 6 weeks there because we were doing a lot of foreign tax planning, because when they do these LBOs, then they need to get cash out so they can pay off some of the debt. And so I helped with a lot of the work to figure out where the cash come from, what the tax treatment was going to be and stuff like that. But it was a fascinating experience. And like at the time, that was the biggest LBO they'd ever done. And like I said, when I read Barbarians at the Gate, it was really cool to me because I had gotten there right after the book ended. But so much of the stuff that the book talked about, I knew about and had knowledge about.
Yeah, remember when people used to smoke on planes and they'd go around with a cigarette cart, and I remember when I was young, like when I was like a little kid, I remember they had in the armrest, they had little ashtrays, and they were always full, and it was like, ugh, so gross.
Oh yeah.
And we didn't have a smoking household, but it was just like, ugh, gross. And they
work-
come around with a cigarette carton, and they had the smoking section of the plane, and all the rest. Oh, this is smoke free, but it's like you're in the seat right next to the smoking section.
Talk about that, Kirk. So the worst plane flight I was ever on. I was living in Tucson at the time, and my girlfriend and I were flying from Tucson to Corpus Christi, Texas, where her mother lived. And we flew Southwest. In Southwest, you get in line and you get your seat. Like, we were in the very last row before the smoking section. And it was so bad, and they could tell how much it was bothering us. At least one of the people was nice enough to stop, but it was crazy in those days how that worked. When you were at the back by the smoking section, you might as well have been in it.
Yeah. Or like you go to a bar and it's just full of smoke, and it's like
you come home, your clothes would stink.
Yeah, it was. What was it like? Right around 2005 or 6? Like it was somewhat recent, where they, at least in Massachusetts, every state's different. Massachusetts, they had no smoking in places where there was food, I think was the law. And then eventually people were just like, whatever, we'll just smoke outside. But yeah, it was somewhat recent. It was like 2010 or 2005 that they stopped that. And I just remember, like when I graduated college, you go out to the bars, you come home, you stink like smoke. And I never smoked, and I hate smoke, but like you just stink like smoke.
Yep.
Like, oh,
I remember one of the companies that I worked for, there was one of the guys in the tax department that he smoked, and he'd go outside, right? And so it would be like this big thing. They'd all have to go outside, and there was this place, someplace outside the building. If you went to lunch and there were a bunch of people, you'd have to walk through it. So even though they were sending them outside, you
Yeah, it's like
still
the
got affected
degenerate
by it.
corner. It's like you feel like you're a criminal out there. Like,
Yeah, and I mean, some of those guys, like they would be outside for a long time. Like you wondered when they ever worked because half the time they were outside smoking.
oh, it's funny. There was a Payne Weber office. It used to be the old Kidder Peabody office in downtown. So when I was at Payne Weber, before they were acquired by UBS, I was in the original Payne Weber office, the first one, and it was 265 Franklin Street. They also had one 2 blocks over, which was Payne Weber acquired Kidder Peabody. And so they had a Kidder Peabody office. It was still Payne Weber, but it was all Kidder Peabody people. And they did whatever the F they wanted. Like they didn't care about Payne Weber. They're like, whatever, we're Kidder Peabody. And so you had some old school guys. Some of them used to do trades for like Michael Milken, like in the junk, like they were that kind of people. They've been around forever. You were not changing what they did. So, when they got rid of the smoking in the buildings, what they used to do is they used to smoke in the stairwell, not outside, inside. So they'd walk into the stairwell on their floor right inside the door, and they'd smoke right there so that they didn't smoke in the cubes. And that was management, because it wasn't just management. It was like the building or like, you can't do this. But so they used to go in there and do the shenanigans they used to get away with. I mean, it was ridiculous. They used to do whatever they wanted over there, and they were successful, so people let them do it. But it's just hilarious how culture changes. And I mean, think about it. Like I looked this the other day. Like the iPhone was invented in like 2009. Really? Like it feels like it was 2000, 2009. Like what were people doing before that? Like we had our flip phones. Like I thought the iPhone was like somewhere earlier, but yeah, it was not that long ago. So if you think about like culture and how much things have changed, like things have changed a lot over the years. And anyway, I think it's just important to recognize as you kind of go through these things. I did want to touch on housing. I don't know. I want to get your thoughts before I dip into this stuff, Phil, as I'm looking for this. What are your thoughts on housing? Where do you think things are going to go? Because interest rates still high. Let me share some charts while we're talking. People don't feel like buying homes right now. Here's a chart you might like.
It's really hard right now, the housing market, because there's not a lot of supply and interest rates are high. And part of it is with interest rates high. Like I know I look at my mortgage. There's no way I'm going to move because my mortgage I'm paying 2 3/8. Why? If I move and I'm going to pay 7%, like that just doesn't work. It's going to add so much to the cost. And so what that's doing is there are people that have to move because they get relocated for a job, things like that. And it gets really hard to do because when they go to move, there's no supply. And if you're getting ready to retire and you haven't paid off your house or you don't have enough for wherever you want to move, you might buy a house that's less than the house that you're selling. But your mortgage is going to go up just because of the fact that the rates are so much higher. It's really a difficult situation with the housing market. We talk about interest rates being high, like from the beginning for corporations, like the companies that build houses, it's not like they have all the capital to build them either. So that's another thing that has an impact on how many new homes are built. And, if you're a younger couple, they're just not building that many starter homes because the profit margins aren't there. So the homes that they're building are more expensive. So for a young couple, it's also become harder to just get started.
Yeah, I will say that the real estate market is setting up for a huge train wreck. And, we talked about this in the show. We talked about it in the last 2 years, whether it's supply or demand or whether it's interest rates. Clearly, I was wrong. I came out and said I was wrong. It's not interest rates because the market hasn't proven me right. Right? It's supply and demand. And so one of the charts I want to show is before we come back to this one is one I saw. And really what it is this. If you look at places like Massachusetts, notoriously, we have a very short inventory of housing. They're not making a lot more of it. And more people want to live here and they're not making enough of it. So real estate prices are staying high. And as Phil said, you can't move because if I bought a $2 million house and then I want to move down to $1 million house, my payments have doubled on the $2 million house. So I'm basically net neutral. So I got a smaller house for the same monthly nut. That's no fun. Who wants to do that? Now, the fortunate part is the boomers, because if you bought a $500,000 house, it grows to $1.5 million. and now you want to downsize. Well, now you got a whole bunch of equity, so you don't need a mortgage. So the boomers can do this, but you basically have traditionally you'd have this this, I don't want to say it's not really a bell curve, but it's kind of like a bell-ish curve. So you start it, so the age 0 here and age 100 over here, and you'll have to look at my fingers on the screen to know what I'm doing. But basically, no one's buying a house at 2, 3, and then 18, then 21, 22, 23. People start buying them in their 20s and 30s, and then at a certain point, it kind of evens off where you just hit 60% or whatever it is, because some people will never own and whatever. And then it starts to tail off a little bit as they get older, because then they want to rent or move into an older home. But the point is like what's happened is that normal curve, that distribution curve that we normally have, has basically been like the Japanese demographic crisis, where it's like they call it the pig and the python, right? You've got this normal, size flow where people are flowing through, but now you get a pig going through the python where you've got this deviation. Because in the normal distribution curve, where you have like 20 and 30-year-olds buying houses, they're not buying them. So now it's just moved further out. And now you've got a whole bunch of old people who own homes, but you don't have a lot of young people owning them because they can't afford to, because it's too expensive. And house prices are not getting cheaper, they're getting more expensive. So not only is it more expensive to buy in the monthly payments, it's also house prices are more expensive. So this is the thing I got myself into, like back in COVID. We sold our condo and we were going to rent for a while, and we thought, real estate prices would drop. And they've gone up, and even though interest rates have gone up, the prices are not dropping. Eventually they'll have to, but at this point it's not. So we're still renting, and I'm okay with that because we're so much cheaper to rent than it is to buy that, it's like at a certain price level, it's like 800,000 in Massachusetts. Anything above $800,000 house, it's cheaper to rent than it is to own. So I could rent a $10 million house and I'd pay like 70% cheaper than it would be to own it. That's the math in Massachusetts. So the point being is it's great on the high level. Just go rent a really nice home and it'd be the same as owning a cheaper home. So point being is if you look at the math works out so that in Massachusetts, it's really hard to buy a starter home because it's too expensive. And you could buy a really crappy starter home house that you don't want to live in just to be a starter home. But the reality is like, who wants to do that? So, you can move to other states and you can do this, right? You can buy in other states and you can afford it. But Massachusetts is crazy and it hasn't come back down. And you can see this in the blue, right? Northeast inventory, right? It's really low and it stays low because people want to live here. We have a very diverse economy. Interest rates pretty much killed this and it's just kind of stayed. And so people aren't moving. Right? Like before interest rates started going up, a bunch of people on my street had a bunch of signs for sale in their house. And as soon as that happened, they pulled them all off. It's weird. These people are still living there. They wanted to move, but they can't because they can't afford to. So that's really kind of causing inventory to disappear. And it's hiding the truth of the real estate market. Now, if you look at Florida and Texas, all of a sudden, lots coming on the market. People are trying to sell, they can't sell. It's becoming a problem. Now, it's not bad because pre-pandemic, it's close to normal, but it's higher than it was. So what that typically means, high inventory, if you think of supply and demand, a lot of supply, less demand, prices go down. So this is going to mean that Florida and Texas house prices should be declining. Northeast, not so much. They're going up, and this is why. Anyway, Phil.
Does the insurance market, do you think the insurance market ties into that too? Like, especially in Florida, because with the cost of insurance, that's made some of these houses also less affordable because you can't really afford the insurance, or the insurance is so high that you can't pay as much for it. Like, it feels like that's another factor here beyond just interest rates.
Sort of, but I think if you look at the data pre-pandemic, we're at similar levels. Pandemic went down, obviously, for people were just, moving to Florida because they're moving out of California, all those other places. Now it's back. I really don't know what the equilibrium is because insurance prices were a problem for like 20 years. So my father-in-law had a condo down in Miami. I think he sold it in 2010 or 12, somewhere around there, because no one was using it. So he sold it. And partially it was because insurance. He couldn't get insurance. It was too expensive. So it's been a problem for a long time. It's getting worse, for sure. In California, it's getting worse. But I don't think it's all of it, but it's definitely, it contributes to it. But you could still, I mean, if you're in Florida and you're in the fourth floor of a condo complex, you're fine, right? You get your hurricane shutters, you get your cinder block walls, you're fine, right? You're not going to get flooded. If you're on the first floor, good luck to you. But so there's certain risks, and I don't know the status of the market right now, but it's always a problem for sure. Anyway, final thoughts to wrap it up here.
I mean, it always comes down to whenever you're making decisions related to investments, do your own research, understand and know what you're looking at. Don't just take what everybody else says. And sometimes the data that you see, you want to go deeper. That second level thinking that Kirk mentioned before is really important. As for me, my firm is Apprise Wealth Management. I know that experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you're facing a new beginning, you can take our Flourish Through Life's Big Changes assessment at apprisewealth.com/assessment to discover how ready you are to embrace and thrive through your significant life transition. You can also sign up for our blog. Thanks for having me on today, Kirk. Enjoyed the conversation.
Yeah, thanks for coming on, Phil. Always enjoy the conversation. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On their website, you'll have access to the show notes, resources, and the archive shows. Also, check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a share rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.